Welcome to the Blue Collar Millionaire Show. I am your host, Chad Hufford, and this is the podcast where we celebrate the unsung heroes of the working world. Each week, we dive into the incredible stories of honest, hardworking folks who have found financial success through grit, determination, and good old-fashioned elbow grease. So if you're ready to be inspired and learn how to turn your hard work into your own success story, you're in the right place. This is the Blue Collar Millionaire Show.
Welcome back to the Blue Collar Millionaire Show. I'm Logan Hufford, and I am talking with Chad Hufford, founder of Veritas, the author of Forging Financial Freedom, also my oldest brother. We're diving back into the book, Forging Financial Freedom, Chapter 4. This is one of my favorite chapters. Know thy enemy. And it's a chapter filled with all these bits of terminology that are words that everybody knows: conservative, safe, stock market, risk. And we as people have it totally backwards on what a lot of these words mean. And that's a big deal, because if I'm misidentifying the enemy, that I might totally operate in a really unhealthy way, a way that's not going to serve my long-term needs. One of the first ones you start off with is literally the stock market. And people talk about the stock market, number one, maybe without even understanding what they're talking about, but also it's seen as this kind of, it's Wall Street and the fancy guys down in Manhattan or wherever. This is ethereal things. There's nothing tangible about it. And some people talk about this as casino in the sky. Like, I throw some money at the stock market and I hope that by the time I'm ready to retire, it's going to rain back some chips on me. But these are things they're misconceptions that are very much perpetuated by the financial industry and the media. And they've been perpetuated for so long that there isn't a point where people went off course. It's just, they've learned to think about these things in an incorrect or at least unhealthy way their entire lives. And they don't know that there's a better perspective, a better way to look at these things. And that's what I was hoping to shift, getting people to think of kind of the big picture when it comes to a lot of these terms, because we can't build our financial futures with an improper perspective of what we're even trying to accomplish, or the risks and the hurdles that we're facing. In this case, if we're fighting the wrong enemy, we're not only fighting the wrong battles, we might be fighting against the very thing that we need to get us to that place of financial independence. A couple of the old-timers that I did not think of these words in this way until I had been at Veritas for a while, and we're having conversations about investing and then long-term financial planning. But the words conservative and safe, those sound like pretty solid words. I want to be safe, right? I don't want to be in danger. And yet the way that people use the word safe investment, is totally backwards. Same thing with the word conservative oftentimes. Unpack that a little bit. Let's go back to what you said about the stock market. So that's just one example, but it's a great place to start before we go into some of these others, because we try to remind people all the time, when you are investing in good growth stock mutual funds, you're not investing in the stock market. You're buying companies, literal brick and mortar companies that make the products and the services and the technology that we use on a daily basis. And some of these companies we've not heard of, but they're real life companies. Right. And that makes it more tangible, but it's also very real. The stock market, if you think of a market, like when you go to Costco, you don't buy Costco, you shop at Costco. So the stock market, as Nick Murray says, is a writhing, hissing bag of snakes, and it's a necessary medium to exchange those companies that we buy through mutual funds. So yes, there's involvement in the stock market, but we don't buy the stock market. The stock market on a day-to-day basis makes no sense. It's like a hormonal teenager. But in the long run, when you own companies, it's a very different experience, and time irons out a lot of the wrinkles and frustrations that are brought by the stock market. And that brings us to this, I think, idea of conservative and safe and all these different things. So we fight the wrong dragon. And financial independence is an income issue, not a principal problem. When I say principal, I'm talking about the amount of money your investments are worth today if you sold them all. Right. Because when we look at our statement, we pull up our statement, that's the number that's in bold. Like that's our eyes are just drawn to it. But that's if you sell off all your companies today. If you do this right, Logan, the folks that we already have retired, actually, they're pretty much just living off the earnings of these companies. If they never sell those companies, how much they're worth at any given moment, even if they're getting ready to retire, isn't super important. It's not nearly as important as how much income those companies produce. So I tell people all the time, I don't care how much your 401k or your IRA is worth today, tomorrow, or next week. What I care about is the moment you are ready for your work optional lifestyle, your job optional lifestyle, the income those companies are producing is enough to maintain your lifestyle indefinitely. It's an income issue, not a principal problem. You don't take your 401k to Costco. You take your income. So we have to get people to focus on income and preserving income more than trying to temporarily stabilize principal, because in an increasing cost world, stable is not safe. And so that kind of unpacks another one of those things. Think about this idea of bringing fixed income into a rising cost retirement. It doesn't even sound like a good idea. When I talk about things like fixed income, annuities, bonds, CDs. Now there's a place for that sometimes in short-term purchases, but retirement, even if you're retiring tomorrow and you're 62 years old, that might be 25, 30 years of rising cost. We have to bring a growing income into an increasing cost world. Fixed income in a rising cost world is just a recipe for disaster. So what ends up happening is people accept a long-term permanent risk, a permanent loss of purchasing power to be a little bit more comfortable in the moment. They trade away long-term security for temporary comfort. And a lot of it is because, or at least is perpetuated because we've misidentified what these terms actually mean and we misuse them.
And so if I have $100,000 saved up and I want to play it safe, I don't want to be risky, I don't want to be dangerous, so I want to just be safe and conservative, I could park it in a savings account and the amount of money that's in the savings account won't go down, right? In fact, it'll go up by a little bit, right? With interest, whatever. But that is not safe when it comes to my financial future.
Then I would even say, I don't even know that's money.
What do you mean by that?
It's currency.
What's the difference?
I would say money as a medium of exchange. If you look at the actual definition, if you pull out, we should have had a nice little Benjamin Franklin $100 bill here, but that is currency. It represents units of currency. Now, there is an exchange with that, but the exchange of value, that's purchasing power. That's, if we're going to nerd out on this.
Yeah, give me an example.
Money is purchasing power.
Okay.
So you talk about safe. Let's go absolutely literal. Let's take $100,000 and let's put it in a safe.
Literally, just
put it in a safe.
Yeah.
In 20 years, and you got armed guards and all that stuff. In 20 years, you pull that money out. How many units of currency do you have?
Still got the $100,000.
$100,000. But I would propose that you've lost half of your money, because at 3% inflation over a 2-decade time period, at average inflation, we've had higher than average years here, but at average inflation, $100,000 would buy in 20 years about 50,000 in today's dollars. So you would say, I've preserved or I've conserved all my principal. I would say that is correct, but it's fighting the wrong battle. You have lost half your purchasing power. You've lost half of your money. So if we go back to financial independence as an income issue, not a principal problem, if I'm fighting to preserve principal, my income is left at risk. My income is all about the goods and services I can purchase over my lifetime on a monthly basis, but projected out for 20, 25, maybe 30 years. We've got folks that we've been working with that are well into their 90s that never expect to live this long and are incredibly grateful that they are bringing a growing income into a rising cost world.
Yeah. You talk about that multiple times of either you will outlive your money or your money will outlive you.
Yeah, those are the two.
Not like just like a cute little phrase. That's a scary freaking phrase to think about.
Those are the two financial outcomes in retirement.
Yeah.
There's a lot of other things that happen in between. And I'm not saying money's the only thing.
But you're going to fall into one bucket or the other.
Either you outlive your money or money outlives you. And so while people are so worried about their 401k or their IRA temporarily declining, which I get it. It's uncomfortable.
Yeah.
And I fully understand that. I'm not trying to brush past that, but you have to accept one of these. If you stabilize your principal today, you will likely permanently you permanently sacrifice your long-term income. If you're willing to absorb some of that temporary ambiguity, you will likely have much more long-term security. It is hard to look past those moments, but in the future, a lot of us should worry less about our money declining temporarily and more about outliving it.
Yeah.
Outliving it either in a sense of our total money, or for people on a pension, things like that, outliving the purchasing power, where you got a fixed income, Social Security, pension, whatever. You might have a nice cushion, nice buffer today. But let's just say you've got a $100,000 pension and you're living comfortably off 80. It won't be more than 7 to 10 years or so in retirement, where pretty soon you got an annual shortfall.
So I'm thinking I'm doing well, I'm budgeting well and all these things, and yet I need to make some plans or else things are about to get really scary.
Yeah. So there's, along those lines, there's a couple questions a lot of people don't ask. A lot of people are looking at, can I afford to retire? They're not looking at, can I afford to remain comfortably retired? Those are two very different questions.
Yes.
And if all I'm looking is, can I retire in 2 years? Then that is my horizon. That's all I'm looking at. And I'm only asking the first part of that question. Can I afford to retire? Yes. I want to stabilize everything because I want to know exactly what things will look like in 2 years. The problem is then we sacrifice the next 20. What we need to look at is, can I remain comfortably retired? Can I remain in a job optional lifestyle for a very long time, which is looking at the direction and duration of my income. When I say direction, I'm saying, does my income increase at least the rate of inflation?
Okay.
And can it last 20, 30, maybe even 40 years? Direction and duration. Those are the two questions that we need to ask. What is the direction of my income? What is the duration of my income? When we're looking at, can I afford to remain comfortably retired for a very long time?
Yeah. So you talk about fighting the wrong dragon. This is a heck of a dragon. Volatility. Or some people might use risk as it's a different word, but both of those things, I definitely don't want that. I don't want things to be shaken up. I don't want turbulence. Nobody wants that, we think. You place the argument that we actually do want volatility. Why?
That's what produces the returns. It is the temporary uncertainty that places the premium on owning companies rather than lending to them. Because let's just be honest, if you own bonds, you're buying a company's debt. And some people would say, no, I don't. I buy government bonds. I don't buy corporate bonds. You own the government's debt. Is that any better? Probably not. I would rather own the company rather than buy the company's debt. And when I make that choice, there is a lot of ambiguity that I'm faced with in the short term. So a couple things on that. Some of that is the premium of return. The temporary uncertainty is what puts the premium of return, which I believe is a margin of safety. I believe owning companies provides a margin of safety over bonds, annuities, other forms of fixed income. But there's always a cost. Nothing in life is free. And part of that cost is the emotional toll it takes of not knowing how much your $100,000 is going to be worth today, tomorrow, next week, next year. 100,000 might eventually become $1 million. It might visit 70 on the way there.
Right.
Now, when you're at $1 million, you don't care. You really don't care what the stops were along the way. But when your 100,000 visits 70, you're not thinking about the million that it might be. And this kind of goes back to our previous conversation about having a blueprint, where that allows us to take us out of the moment and say, here's where we're headed. We're in this uncomfortable spot right now, but this is what we're building towards, which is super important. So you have to have a plan, not just a portfolio. But when it comes to this idea of temporary volatility, people love volatility. They just don't like it in a negative direction. Somebody's 401k or the IRA goes up 25% in a year. Nobody's complaining about that.
It's true.
That's volatility too.
Right.
Volatility is just a sudden change of direction, a sudden and substantial change in direction. That's all. So when you complain about volatility, giving away those negative, you're also going to give away the positive.
Right.
So we have to take I don't even say the good with the bad, because the negative volatility isn't even bad. It literally allows us to buy the best companies in the world on sale.
It's something I want to circle into. Just as you're talking, it's making me think. I think through life, just any area of life, if I want certainty, I have to pay for it. Like certainty is not given away for free. And it's no different in investing, is what you're saying.
Certainty exacts a very significant cost in any area of your life. I think that's why people stay in bad relationships, why people stay in jobs that they hate, that steal their soul.
Yeah.
But it's that thing, the devil you know is better than the devil you don't.
Right.
And a lot of people choose a life imprisoned by their current circumstances because they're afraid of stepping into the unknown. Even though the possibilities might be so much better than they're in right now, it's the unknown. And that's what keeps people trapped. And this goes so far beyond money.
Right.
In fact, I would say more times in life, our intolerance for ambiguity and our need, or at least our intense desire for certainty, keeps us trapped in ways that are even more impactful than finance, maybe beyond the scope of this podcast. But I would encourage people to think about that. Like, where does your desire for certainty keep you trapped? With investing specifically, we just stay focused on that. What it does is it causes people to trade away their long-term security for short-term comfort. It's a horrible trade.
And going back to the idea of, so a market decline, this is another drag in it. That seems like an obvious bad thing, right? It doesn't feel enjoyable to look at a statement paper or on the computer and go, okay, it's lower today than it was yesterday or last month. And yet even that, and this might rub some people the wrong way, but even that, there's opportunity in that. You talk about that being an opportunity, not an obstacle, and how we view sales as humans in every single area of life except one. Why is it different? Or what does that look like? Why it's different with this one area?
It goes back to how we look at things, how we talk about things. We talk about the stock market and it's intangible. And our industry, the financial industry and the financial media very much take everybody into today. Like we're not thinking about 6 years in the future, much less 3 decades. We're not even thinking 6 days. It's about what happened 6 minutes ago. And that's what's so much the focus. So if you have a myopic, short-sighted view of the future, where you're looking in days and weeks and months and maybe years instead of decades, but especially days, weeks, and months, then volatility is catastrophic. Because my 401k that now looks like a 301k might not recover for a few weeks or a few months. And every now and then it might even take a couple of years. And if my viewpoint is till the end of the year or till my next quarterly statement comes out, then it looks catastrophic.
Yeah.
But we have to think about things differently. In order to think about things differently, we have to talk about them differently. And that's why reframing this to get people to look at this in a healthier perspective. You don't own the stock market, you own shares of regular companies. So if you have 1,000 shares of whatever mutual fund or groups of companies, and those shares go down 10%, you didn't lose any of those shares. You still have 1,000 shares.
Yeah.
If you sell them all today, you'll get 10% less money. So how do you solve that problem?
Buy more, or at least
Don't sell.
Yes.
So losing money in a diversified investment is very much a human phenomenon. We have to create that by selling during a decline. What that does, it takes a temporary decline and turns into a permanent loss. And like you said, Logan, in no other way do we think this way. People in Kempton Hills, Anchorage, people line up like the day before for the Kempton Hills garage sale so they can buy somebody else's junk that wasn't good enough for Craigslist at a discount. They literally wait in line. It's like everything that I hate about the fair combined with not wanting to buy other people's garbage. Let's be honest. That's what a garage sale is. You're basically voluntarily giving your money for the privilege of taking out somebody else's trash. I'm going to probably tick some people off with that because I know we got some thrift shoppers out there, but that's what a garage sale is. But with the stock market, with companies, the stock market is the only store where everything goes on sale and people run the other direction.
And then if and when prices go up, then we feel like now I should go buy that thing. Whereas I wouldn't do that at the grocery store.
And this is why words matter. Because when we talk about the stock market, that sounds very differently. This sounds very different than I have a portfolio of some of the best companies that have ever been on the face of this planet. And the value of those has been down a little bit, but I have the opportunity to buy even more of those companies at a discount. And it frames it. We're reminding ourselves and we're reminding each other, we own companies. That's a pretty cool thing.
Right.
To be able to own some of the most profitable, most cash flush, largest, most innovative companies that have ever graced this planet. And you and I can own them. The people listening to this podcast can own them. That's amazing. You're just gonna have to weather some storms in order to get the full impact of that. So this isn't about beating the market, whatever that means. That's why people try to move in and out, timing the market, trying to avoid the storms on it. We just need to capture it. We capture it. Own companies rather than buying their debt. Own companies rather than lending them, because we need to take a rising income into a rising cost future.
And the way that people can do that, the best way that I think you and I know about is having conversations with you, having conversations with their financial advisor, where we can talk about the storms that have hit. We can talk about a fear, right, that I might have, a fear and an uncertainty that I have, and have those conversations. And that's part of what we do every day, right, is have these conversations with folks. We don't expect them to not have fears, but we can talk through them.
And going back to that previous conversation too, about having a plan, you need to know what your plan is, because the biggest risk is, you already mentioned it, running out of money in retirement. And with a plan, you can see what will cause that risk to more or less likely come to fruition. So anything you can do in your plan to reduce that risk is actually a safer investment. Without a plan, it's really hard to see that. Without a long-term strategy, then you're just looking at the moment. You can't see through the storm, and you're very likely to react inappropriately in choosing the present over the future, because you don't have a plan to connect you to what you need in the future. So that's why it's so important to have a strategy and a mindset that aligns your actions and decisions and choices today with where you want to be in the future.
So guys, the second best way to reframe and have healthy thinking around this, keep following this, keep tuning into this podcast every week, keep checking us out on Instagram. We're always going to be putting educational, helpful, and relevant content out there in this medium, social media. Stop in, have a conversation with us, and let us continue to walk with you as we have these conversations.
And we'll help you find out the risks to your long-term future that you need to be paying attention to.
Thanks for listening to the Blue Collar Millionaire Show. We hope this episode has been inspiring and beneficial to you. If you want help on your journey to financial freedom, reach out to us at veritasalaska.com. We'd love to sit down over a cup of coffee with you, either here in our office or virtually, and get to know you and your needs. And though this podcast is free of charge, we do ask that you please do us two quick favors. If you enjoyed the episode, give our pod a great rating on iTunes or whatever podcast platform you use, and also give us a follow on Instagram. We hope you have a wonderful day filled with gratitude and intentionality. God bless.